Welcome back to the JumpifyLabs podcast, the show for founders who want growth without the guesswork. Here we mix data, AI, and real talk around the systems that drive predictable growth. And today's guest is someone who's been deep in a sector that most people don't realize is becoming the new oil. Kamar Jones runs a hedge fund that acquires junior mining companies, the same minerals behind EVs, microchips, and infrastructure the world is scrambling to secure. If you care about diversified returns, this show's for you. Kamar Jones, welcome to the show.
Hey, thanks, Jay. Thanks for the cool introduction, and I'm looking forward to participating in the podcast.
Pleasure's all mine, brother. For listeners that are new to the mining world, how do you explain what your fund does in the most simplest terms?
Okay, yeah, that is complex, some things, but as far as what we're doing, we're buying companies that are on sale. We're trying to get at a deep discount. Essentially, it's like going to the store, going shopping, seeing a store that's closing and buying some of these clothes, and then turning around and placing it into a new store that's more attractive and then selling it at a profit. So we just to give the short summary of what we do, we're deep value investors. We take a bottom up approach and we buy junior mining companies. We provide professional and technical services in order to increase the intrinsic value of that asset. And then we'll either exit through selling to a mid tier or major, or we'll take it to extraction and then make cash flow off of the production of the minerals that we mine. So it's either those two ways.
Right. And talk a bit about how you talk a little about your history and how you got into this space.
Say that again, Jay. I'm sorry. Got a little
Yeah.
feedback.
Talk about your history and how you got into this space.
Okay, yeah, thanks. So this goes way back, even when I was in my 20s, early 20s. I started in capital markets at a firm called Merrill Lynch. Worked at First Union Securities, which became Wachovia Securities, which became Wells Fargo Securities. So I did some 8 years in that area. And then I did some entrepreneurial things for about a couple of years. And then I migrated to management consulting, which is typically your McKinsey and Company, Deloitte's, Bain, those kind of guys. And I got plugged into the mining sector kind of out of default. It was an area where people were doing really well financially. So I raised my hand to get involved in that. And throughout those almost nearly 20 years of being a management consultant, I've built some great relationships with some mining executives and key people in the industry. And that afforded me the opportunity to launch this hedge fund called PPI Capital, which was launched in October 2024. Combining my capital market experience along with my mining consulting, heavy industry, oil and gas type experience, it was a perfect setup to, because I'm comfortable with financial instruments and intermediaries and speaking that kind of language, evaluating different things. Plus, the boots on the ground experience that I received by consulting and making relationships with different executives globally. So it seemed like a perfect combination. And it has been helping as far as the growth of PPI.
Just a perfect storm, it sounds like.
Yeah, yeah, exactly. The one, my mentor that worked at Merrill Lynch years ago when I was in my 20s, and I had talked to him about this. He said, "You're the right guy at the right place at the right time." He said, "Because you understand these things and you've got the experience and all these other things." He said, "It's essentially almost a perfect storm."
Yeah. And how are you finding businesses to buy?
Yeah, that's a great question. Typically, through my network and ecosystem, I mean, deals will come across and I'll take a look at them. People reach out just in general. They know what I'm doing. They know I'm in the mining space. So you look at deals that way. And then I attend investment conferences where I get to speak with the C suite of different firms in the junior mining space and see what they're doing and see if it fits my objectives and my threshold. And so a combination of those, I mean, I've looked at hundreds of deals this year, at least hundreds of them. And we're very selective because we're value managers. And so we're very selective. We're not just throwing money at anything. It's got to fit a certain criteria and objective. And it has to at least have the opportunity to annualize a 30% IRR. and get the cash within 18 months or less. If we make an investment, if I'm cashing out at the 18 months, that's roughly about 45% or 30%, roughly annualized.
Okay. And when you get business, when you're about to go in and build value to it, what are you looking to improve straight away?
Yeah, that's another good question, and I like the discussion because it could talk about this stuff. Let me back up and then give a briefing of the mining process at a high level. So you start out with prospecting, which is essentially geologists, those kind of professionals. They go out and they look at the geographical location, and if it has certain minerals or things at the surface, it could be the possibility that it there is minerals that people want to mine there. So they do that, do some drone studies and some other stuff. And then it moves into what's called exploration. Exploration is actually validating how much is under the ground and is there a business case to actually mine that? And so exploration is actually the longest phase of the mining phase. It's about 5 to 10 years in some cases. Prospecting 1 to 2 years, it's maybe three. So then you do that, and how you do that, and this is where we play at because most of the returns are made in the exploration stage. And so you have to do an assortment of different studies using drill programs where you're actually sampling the earth underneath and you're getting these samples and sending it to a lab to get results. This lab then builds up data that you have that can then start to prove and validate how much minerals is in within this area that you own, this particular piece of land that you own or leasing. And so once you do that, now you can say, okay, we got, and I'll just use gold as an example. We've got a million and a half ounces of gold that we project. But that's still not enough because now you have to, just because you have a million and a half ounces of gold that you can validate through different studies, and and that's called a mineral resource estimate. You have to prove that it's economically viable. Because if, let's say, you had a lot of gold on the moon, it could be there, but how much would it cost to get it? And so the cost may be too much or not enough return to bear the risk. And so now you need to do additional studies with metallurgists, geologists, and other mining professionals in order to start to build a business case. You may have to do some additional drilling so you can get even better, a better idea where the minerals are, how deep they are, how wide they are, what the grades are, what the makeup of it is. A lot of times you have polymetallic ore that you're projecting, meaning there's multiple different types of minerals, and then you got to extract those, and sometimes that can cause more complexity. So do all these different studies and things by nerds that forgotten more about this than I'll ever know. And then you then can put together a business case, long study, and then what we call the initial economic assessment is called a preliminary economic assessment. Then you can go even further and get a feasibility study and even further a bankable feasibility study, which means that essentially this is something there, it's economically viable, and it's worth building a mine to get it, which then you can actually go to lending institutions and other things to build that mine. Now you to that phase, now you build the mine, that's called development. That's the third phase, development or construction of a mine. Once you do that, and that could be between 2 to 5 years, 1 to 5 years, something like that, depending on the project. Now you're extracting minerals. That's where it finally, after all that time, you're finally you're making money off of this mine. And from there, then you get to the end of it. Let's say you trained all the resources 20 to 30 years later, and now you do reclamation, which means you have to put that earth back the way it used to look before you started mining. And so we like to play in the exploration area. We may take an exploration project and get it to production at a small scale. And as we grow more and more with our ecosystem, we may be able to take on larger product projects and do more extraction, which can then generate a cash flow too. But right now we're primarily buying, selling, at a certain point once it gets to a preliminary economic assessment or some type of feasibility study, and then let bigger, larger institutions carry it to extract. I know that's a long answer, but I thought it was necessary to explain that process. And that's where the expertise and the complexity comes in, is that you have to develop it all the way there to there.
That sounds like quite an extensive process with multiple hands on deck just to get that evolution under control, keep it moving down the process, down the line. Requires capital for sure. You
Requires
mentioned
that.
raising, or your target last time was 3 million. You ended up raising five. Talk about that process a little bit.
Yes, we took a different approach because I wanted to get hit the ground running. And so as I was raising money, I was putting it to work, like raising money and putting it to work. Typically, sometimes you'll just raise a bunch of money and then go out and start investing. There was deals coming across that were very hot, lucrative, and the opportunity and the window was small. So as I started raising money, I started putting it to work. And so most of a lot of those returns, not most of it, a lot of the returns of exceeding that benchmark and target was due to the capital appreciation of these publicly traded assets that I was buying for this hedge fund. And so the returns on the portfolio from inception is somewhere on the public side X. And if you factor in some private assets, we're looking at close to five, 4.5 to 5. And so that's what got us to the 5 million under management right off the bat. And the next round, we're looking at raising an additional 6 to 10 million on top of the assets under management that we have. And it'll be the same way, Jay, if the market, and I'm projecting that I should hit somewhere in the neighborhood of about 14 million, 15 million under management with some reasonable returns, not the 3x that we got over the last year, but much smaller and in line with our original benchmarks is what I'm banking on. Now, if we do better than that, of course, that'll be even better. We'll take it. But that's kind of the projection. And we believe we'll be there at least within a year. So sometime fourth quarter 2026, we should be done raising money.
Amazing. That sounds like, I
Yeah.
mean, raising that much and getting to that point in a short time is no small feat, brother. So kudos to you for doing that. What's next for PPI? I know you're always looking for the next acquisition, but where's most of your focus and energy going towards now?
Okay, so we're still looking at deals. We did a small acquisition. I got an opportunity to get on board on a small private placement. Picked up a little bit of that. All of our private placements, what's really spiking the returns is what's called warrants. And let me explain what that is, because everybody can't get them. In the private placement, let's say you buy, let's say 1,000 shares. I'm just going to use that as a number. You'll be giving the shares itself, obviously, at a certain price, and typically our price is at a discount from the market because that's to entice some of the institutional investors and players in this market that buy these guys. So they typically, we're looking for deals. So it's going to be typically lower than where the market's at. In addition to that, we're offered warrants with each share that we buy. Sometimes it's a half, sometimes it's a full warrant. And so what that means is that once the price gets to a certain level, then we're able to exercise those warrants into full shares if it's a 1-to-1. And so you've essentially doubled your position once the stock price hits a certain level. And that just adds to the returns that you've already gotten. And so that's why some of these positions have gone up, and there's no exaggeration, 5, 6x within a short period of time. Because if these explorers run up like they do, and then the warrants are in the money. Now those warrants are worth something, and you can count that and the principal with the rate of returns that you get. And so that's the what I call the secret sauce is acquiring warrants with your positions because and what does the company get for that? Once their stock price performs a certain bit, they get additional capital from the warrants because investors are going to exercise those warrants. They're in the money, so it'd be stupid not to. So they get additional capital for the warrants that they've issued. They've already diluted those warrants, or they will get diluted at that time. But for the investor that does have the warrants, that's a pretty good kicker, as I call it, on top of it. And the only way you get these warrants is typically through a private placement that's only offered to a certain group of people. And so that's the value proposition. Even if you knew what I knew, was able to do what I do, if you don't get into the private placements, you're still not going to get the warrants, so you're not going to get the full bang for your buck like I can.
Yeah, very interesting. Yeah, so it seems like there's a little bit of, I wouldn't say a hurdle, but there is a bit of a qualification process before someone can just step into the space.
Absolutely, it is. It's high barriers of entry, and so even again, if you had the money, where do you put it? How do you know who's the good guys, who the bad guys is? How do you evaluate these deals? Do you have the resources like a geologist and metallurgists and everybody else that are involved that can analyze these deals and then work on these projects to help deliver these studies like the mineral resource estimates or the preliminary economic assessments or the feasibility studies, pre-feasibility studies, bankable feasibility studies, do the drilling programs, manage it. I mean, it's a lot more involved than it just buy, hope, and pray because we are active managers. We're not just passive and give money and then buy, hope, and pray it goes up. We're involved in it. We have levels. Sometimes we have board seats with people that we know, so they can be watching over these things from the inside. And then on the project itself, we'll have boots on the ground that's participating on it and then combined with like my mining experience along with the ecosystem, this is how we can make money in this very difficult space to make money in.
Yeah, very interesting. It's such a cool space.
Yeah,
You
it
came
is.
from the M&A industry, so buying businesses, putting in part of a bigger fund, private equity, all of that. That's a conversation that I came from that space, so I'm really interested in it. But for anyone that wants to learn more about you, what you guys got going on at PPI, where's the first place they should look?
Well, the first thing I would look is if people were interested in becoming a shareholder of PPI. Unfortunately, we can only take accredited investors. You have to be because of the regulation of this fund. It's high risk, and so forth. And so far, it's not suitable for everyone. But the easiest way is you can see me on LinkedIn. All the information's there. We do have a website, but where it's under the process of being reconstructed. And I think I had explained that to you just in our private conversation that we are doing a lot of rebranding. And I mean, I've got an excellent team that's helping with that. And it looks way better than the stuff I put together on my own. I'm laughing at it now. I was pretty proud of it. I was like, man, this looks pretty good. Let's help you get to the next level. And so I think that's going to be done the end of this quarter. So we got about a month, and most of that will be done. So I would say the easiest way: reach out to me on LinkedIn. I talk to anybody, even if you're not an accredited investor, and you just want to understand and learn about what we're doing. I can block out some time and explain to people. I do all the time. I love talking about this stuff, and everybody that's involved. We love this space. We love mining. We've been to mines. It's not. I call it. I call it. We got boots, not suits, because a lot of times people depend on Wall Street analysis in order to make decisions. Those people are not in mines. They never will go to a mine. If they do, they ain't gonna know what they're looking at because it takes, unless they were former geologists or something like that, which most of the time that those worlds don't blend. So we know what we're talking about. We know what we're doing. We're watching over the industry like a hawk, and we got our nose to the ground as to any recent developments or changes. And so make it easier and best along with us.
It's interesting for me. It's also interesting for a lot of people, I'm sure, in mid to later parts of their career. Maybe they have a little bit extra to invest somewhere else. Will definitely be an avenue worth exploring for sure.
One thing too is great for diversification. The
Exactly.
does not correlate with the S&P 500 or any of the major indices. It does its own thing based on what it's doing. So. Just wanted to keep that in
Yeah.
mind.
So
Diversification.
absolutely.
Mm.
Everyone talks about crypto. They talk about the S&P. That's kind of a given. But now there's mining.
I'll go with the junior mining space because it's in mining, but it's even concentrated because it's in that one phase out of five that I explained to you, the different phases. And so one thing that's unique is that a lot of these, even though they may be small, they're publicly traded because that gives them access to capital. And so you got better transparency there, even though most people wouldn't know what they look like or what they should look like because explorers aren't generating cash. So how do you determine if they're good or not? That's not easy to do.
Yeah, absolutely. So if you're listening to this and you want to explore this area more, Mal made his inbox open. Shoot him a DM on LinkedIn or check out their website. If you like more conversations like this, if you want to hear from other leaders like Kamar, tune into the Jumpify Lab podcast for more. My name is Jay. Thanks so much. Talk soon.
Thanks.